Hi guys, it's Stock Curry, and the stock market is teetering on the brink of collapse. Friday could kickstart a massive sell-off that lasts for the next 2 to 3 weeks. I'm going to show you everything that you need to know in today's video, so let's get into it. Whenever we're doing stock market analysis, we have to consider both the technicals as well as the fundamentals. The fundamentals will very often tell us the direction of the stock market over time, but it's the technicals that give us the timing. And unfortunately, both of those are coming to a head, and they're indicating a massive stock market collapse that could start as early as Friday. So I'm going to go over everything you need to know in today's video. Let's start with the technicals, and then we'll get into the fundamentals. What I have pulled up on the screen here is a chart of the VIX, V-I-X, which is a volatility indicator. And this is essentially a measurement of how many put options are being purchased versus how many call options are being purchased on the SPX. The SPX is an S&P 500 index. Now, everything I have highlighted here in yellow is when the MACD creates what's called a golden cross. A golden cross is when either these red bars turn into green bars or the gold line crosses above the blue line. It's called a MACD golden cross. And every single time that has happened for the past 4 times in a row, what has happened, and by the way, this is the weekly chart. Very important you know this is the weekly chart on VIX. Every single time we get a golden cross on the MACD, the VIX skyrockets upward, well above 30 every single time. Now take a look at the far right. This is where VIX currently stands, and it is on track to have a golden cross next week. Again, this is a weekly chart. If you look at how long these weekly candles last every time we get this MACD crossover, you will notice that they always last right around 2 weeks. It's 2 massive weeks up. So with the VIX on track to have a golden cross on the MACD next week, it indicates a massive spike in the VIX, or the volatility index, over the next 2 weeks, next week and the week after. Now, what happens when volatility increases? What happens when the VIX spikes upward? Well, generally, the VIX is only going to go up if a lot of people are buying put options. And why would people buy put options? Because the market is going down in a massive way. So each time we see the VIX skyrocket upward for 2 weeks, we see the stock market crash downward for 2 weeks. So technically, the VIX is indicating that next week and the week after, we are going to have a major crash in the stock market. Now, this is also backed up by some of the technicals on the daily charts, where pretty much all of the daily charts on the market indices have turned bearish. The one thing that has not flipped yet are the weekly charts on the market indices. They are all still bullish. However, the Dow Jones DIA ETF is on track to have a MACD death cross next week. And this could all kickstart this major crash where the weekly technicals, which have remained bullish for the past couple of months, could turn bearish starting next week. All technicals are lining up for a major market crash over the next 2 weeks. Now that's the technicals. What about the fundamentals? Well, when we're talking about fundamental analysis, it's all going to come down to what the Federal Reserve does with their rate hikes, because this ultimately is going to determine if the market goes up or down. When the Fed meeting minutes came out on Wednesday, it showed that most Fed officials favored a 1/4 point rate hike. And that's exactly what the Fed did in February 1st during their meeting. They did a 1/4 point rate hike as expected, and the stock market generally rallied. Now, there were some comments made by Jerome Powell after that meeting where he said they are not going to lower rates this year. It's not going to happen. And in fact, not only are they going to raise rates, they're going to keep them elevated for a lot longer than market participants expect. Now, he stated this the first time he was questioned about it. He stated it the second time he was questioned about it. Then he was questioned about it a third time. And by the third time he was questioned, the question was, well, what if the market does get down to a 2% inflation rate? Would you lower rates? And Jerome Powell said, our data does not show that inflation is going to get down to 2% by the end of this year. However, if by some miracle inflation gets down to 2% by the end of the year, then yes, we would lower rates. And the market rallied and the news reported Jerome Powell says he'll lower rates by the end of the year if we get down to 2%. They completely leave out the fact that Jerome Powell said their data does not show in any possible scenario that this will actually happen. He was just stating that by some miracle, if it were to happen, that the Fed will lower rates. Yet the market ignored all of that and they just focused on what they wanted to hear, which was there's this 0.00001% chance that the Fed might lower rates by the end of the year. And that's what the market's currently pricing in. The market's pricing in 2 rate cuts by the end of the year. Now, this, of course, is ludicrous and ridiculous, but that's where the market currently is. It's a bit insane when we talk about the fundamentals. The market isn't always going to trade on the fundamentals. It will very often trade much higher than the fundamentals and much lower than the fundamentals because the market whipsaws back and forth and it tends to become overbought or oversold. Recently, the market became overbought and now that has to get corrected. Now, another thing that the Fed minutes showed on Wednesday was that the Federal Reserve will keep fighting inflation with more rate hikes. And they reiterated their concern that inflation is still very high. So despite the market's hope that the Fed would lower rates by the end of the year, the meeting minutes made it pretty clear that is not the case. Stop trying to expect that, markets, because it's simply not true. Yet, the stock market generally brushed off this report. It even rose quite a bit on Thursday. Tomorrow, though, we have some data coming out that could flip everything. I'll get to that in a minute. Let's finish up with the Fed real fast. The Fed's James Bullard has pushed for faster rate hikes and says they have a good shot at beating inflation if they get more aggressive with their rate hikes. So the Fed's being pretty clear here. They are going to keep raising rates. So we'll have to see when the market wakes up to this reality. We know it will. We just don't know when. Let's keep going here. Jamie Dimon says the Federal Reserve has lost a little bit of control over inflation. Okay, this is actually scary if it's true. The problem is if the Fed does not raise interest rates fast enough, then inflation will actually turn around and inflation will start going back up again. Now, one of the things that Jerome Powell keeps saying is that financial conditions are currently tight. And the Federal Reserve's own data actually shows that financial conditions are loose and they're actually getting looser. Now, we're going to get more information on this on Friday, which I'll share with you in a second. But I want you to understand that what the Federal Reserve has done so far is not enough. They have to keep raising rates. They have to raise them higher because the January CPI and PPI inflation reports showed that inflation is coming back. It is on the rise once again. This is certainly going to scare the Federal Reserve. January's super hot jobs number is also not good for the Federal Reserve. And they have a lot of reasons to do a 50 basis point rate hike in March rather than another 25 basis point rate hike. In fact, the stock market is now pricing in a 25% chance of a 50 basis point rate hike at the next meeting in March. Now, another thing that's about to hurt the stock market in a major way is the bond market. Some treasury bills are now paying 5%. And as bond yields rise, this causes the stock market to go down. And the reason for that is pretty simple. If you have a large amount of money Why would you invest it in the stock market that could drop significantly and possibly even lose money in the hopes of generating an annualized 8, 9, or 10% return when you could put your money into the bond market, which is relatively safe, and generate a nearly guaranteed 5, 6, or 7% rate of return? Most people with very large amounts of money would choose to put their money into the bond market where it's safe and generate pretty close to stock market returns rather than risking another 20% down year like we had last year. And that causes money to flow out of the stock market and into the bond market. And when money flows out of the stock market, stock prices go down. So this is one thing that very, very soon is going to start causing a lot of downward pressure on the stock market. Over the past 3 weeks, we've already seen a lot of outflows out of the stock market. We haven't really seen prices fall too much because there's still a lot of buying from retail investors. But eventually that's going to come to an end and stock prices are going to start going down. Now let's get to the data that's coming out on Friday that could kickstart this stock market crash that the technicals are pointing to. On Friday at 8:30 a.m. Eastern Time, that's 1 hour before the market opens, we get the PCE, or the Personal Consumption Expenditures Price Index. Yes, that's a mouthful. The PCE is coming out at 8:30 a.m. Now, core PCE is what the Federal Reserve is mostly looking at, and this is what they're trying to get down to 2%. It was 4.4% last time, and it's expected to come in at 4.4% again for January. But the month-over-month increase is expected to be 0.5%. Now, that's a pretty significant increase in PCE. And there's something you have to understand. The way PCE is calculated is different from the way CPI is calculated. Even though they're both measuring the price of consumer goods, they're calculated in a very different way, which is why we get CPI at 6.5% or 5.3% core, and why we get core PCE at only 4.4%. Now, the other thing you have to understand is core CPI already rose 0.5%. But if we got the exact same percentage increase in PCE on Friday, it would actually only represent a 0.4% increase. Now, that's good and bad. One, it's good because it's less than what the market is expecting. So if PCE comes in line with CPI, we'll get a 0.4% month-over-month increase and a 4.3% annualized increase. And that's going to look really good because the market's expecting something higher than that. And more than likely, the stock market would rally on Friday because PCE comes in lower than expected. But just like earnings, where a lot of the earnings have come in and they're horrible and they're showing significant declines year over year, yet the stock prices have risen on these bad earnings because the bad earnings aren't as bad as expected. The same sort of thing happens with PCE, where the PCE comes out, it's horrible, but it's not as horrible as expected. And so the stock market rallies on Friday, maybe. If PCE comes in 0.4%, stock market should go up on Friday. But then we got to get back to the Federal Reserve. And the Federal Reserve is saying 0.4% month-over-month increase in PCE is completely unacceptable. And even though it's not as bad as the market expects, and even though the market might rally on Friday if PCE comes in at 0.4%, the Fed will probably look at it and say, this is bad, and might lend a little more credence to a 50 basis point rate hike in March rather than a 25 basis point rate hike. So it could be good for the markets on Friday, but bad for the Fed. And that might hit us later in the day, because later in the day on Friday, once the market is opened in the afternoon, as the market starts to get close to close, we have a lot of Federal Reserve members speaking. So even if the market rallies Friday morning on a lower than expected PCE report, it could sell off massively Friday afternoon when these Federal Reserve members start speaking. At 10:15 a.m., we have Fed Governor Philip Jefferson and Cleveland Fed President Loretta Mester both speaking. Then at 11:30 a.m., we have St. Louis Fed James Bullard speaking. Then at 1:30 p.m., we got the Boston Fed's Susan Collins speaking. And then at 1:30 p.m., we have Fed Governor Christopher Waller speaking. So that's 5 Fed people on Friday who could crash the market if they come in hawkish, even if PCE comes in lower than expected. Overall, it's really hard to say what's going to happen on Friday exactly. But one thing we do know is that with the PCE coming out and all of the Fed members speaking, it is going to be a very volatile day. Probably a great day for day traders. Day traders probably going to make a ton of money or lose a ton of money on Friday. But man, it is going to be volatile. Very, very, very difficult to predict. However, after Friday, getting into next week, the technicals indicate the market's going to go down. For that reason, the play that I'm going to give you guys is I am going to buy VIX call options on Friday. And those VIX call options, I'm going to buy them to expire on March 22nd. And I'm going to probably buy the 22 call options, the strike price of 22. Now, keep in mind that VIX options are not like normal options, meaning you don't exercise them. You can't just sell an option or exercise it and get shares because there's no shares of VIX. It's not an ETF. It's a index, a volatility index. You can't get shares in it. So when you're trading something like VIX or SPX or many of the others, they run a lot more like European options, meaning you just let them expire and then it's done. They just stop trading. There's no exercising of the options. So just keep that in mind. They still have theta decay. They still have volatility that's built in. It's still like a normal option. There's just no expiration of it. So you don't have to worry about selling it at expiration. You can just let it expire even if it's in the money. It doesn't matter. So that's what I plan to do is VIX call options at a strike of 22 expiring on March 22nd. And if you want to know everything that I buy and sell, come join us in the VIP Discord where I post my trades. We talk about how to trade options, how to make money with options. More importantly, we teach you the more complicated multi-leg options, including vertical spreads, credit spreads, put spreads, iron condors, and a whole bunch of other types of options so that you can make money no matter whether the market goes up, down, or even trades flat. And if you want to learn how to trade options and make money in the stock market, no matter which way it goes, then make sure you sign up for the We Profit Day and Night coaching program. If you want more information on that, you can schedule a call with an onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video with your friends and family. And don't forget to hit that like button and subscribe. And if you want my most recent market update, if you missed the one that I put out a few days ago, make sure you go watch the last video that I uploaded here.